Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We have a lot of things to cover in this video, lots of developments, lots of things going on the charts. We spent the weekend really going over everything that's happened from a technical standpoint and macro standpoint. What have been the driving factors behind this rally? Can we expect it to continue? We're really trying to go at this with an open mind and taking a look at these developments and seeing these developments for what they are. Now, all of this, of course, happens in the context of a very hawkish Federal Reserve, which is the primary concern amongst investors. The Fed has announced, at the very least, 2 more 50 basis point rate hikes this year. And this comes as we're seeing increasing evidence of slowing economic activity. Despite this, we have oil prices that are still incredibly elevated. So definitely a lot of things to worry about in this market, a lot of things to be concerned about. But at the same time, we've just seen the S&P 500 bounce off its 100-week moving average. I believe we talked about this last week. This is definitely something to consider, something to take a look at. This is what is considered to be the bull market moving average, right? And you can see it does act as a very significant level of bull market support. When price is either snapping back above it, it triggers rallies, or finding support around it. And once it is broken, that's when you enter a real bear market territory. So we haven't quite seen that yet. For example, here in 2000, we did break below it, and then we did break below this moving average, and that set off the next phase of the bear market. And we did bounce around it a few times here before eventually breaking down. So you could argue we are somewhere around here. So we're going to take a look at a lot of different things in this video to try and understand where the market is going from here. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. Don't forget to click on that like button if you enjoy these videos. And now, without further ado, let's get right into it. All right, so clearly we had a nice run here last week. This was a pretty bullish development. If you take a look at that head and shoulder pattern we've talked about a few times over the past few weeks, we did see a snapback above it. So that's definitely a better development than seeing price stay under it, right? Because if you see price consolidating like this under that neckline, it increases the odds that you're just going to see a continuation of that, which for now has not happened. We did snap above it, and if we take a look at the weekly chart, we even closed above that line. So that's important to note. You can even move around, you can even move this neckline around on that weekly chart to fit it better with those weekly closes. I like to look at these patterns from multiple angles. It still looks good even if you put the neckline a little bit higher, right? And I can show you what that looks like on the line chart that just takes into account those weekly closes. That's a beautiful head and shoulder pattern that broke down here in April, and we did close above it. So take it for what it's worth. Leave a comment down below what you think of this development. From a purely textbook technical analysis standpoint, it is pretty bullish. Now, if I jump to the 4-hour time frame, and I don't like to look at the short-term technicals too much because they can lead you in the wrong direction, but look at what happened here with the RSI. We got very, very overbought here. Unfortunately, I didn't discuss that in the last video, but seeing the RSI so overbought is generally not a very good sign in the very short term. And that's expected, right? We had I believe it was a 10% rally off the low here. That is massive. And very quickly, with little to no pullbacks, you're going to get some type of a pullback after that, whether that's short term, whether it's more violent or it's just a consolidation. You can expect that. What is a little bit more concerning is that we did see the same overbought reading here at the top of March 2022 here. I remember that very well because we were talking about this right here, expecting a little bit of a pullback on the S&P 500 as we saw this. If we go back further, you can see these very overbought readings do tend to coincide with local tops in the market, right? And this is very short term, but you can see these are definitely local tops every time it occurs. Now, it is important to nuance this because these readings that I'm highlighting here didn't occur after a 20% move down in the market, right? So it's very peculiar price action we're seeing here in the short term. But now what I really wanted to show you guys in this video is this article that we posted on Monday asking the question if we are about to see a rally here based on the developments that we saw. We took a look at a bunch of different things, but one of the things that we took a look at was the strong momentum. And so you can see the angle we took a look at this from is that the 3-day rate of change has made quite an impressive move up. Now the rate of change is just the momentum of the market. So it compares where price is now compared to 3 days ago, and it gives you a reading. So you can see we've had a nice thrust up, and what we identified, and in fact we're talking about the same thing back here in March 2022, but if we come down to this next chart that we highlight, is that these occur near significant bottoms, right? And I put vertical lines every time you see these readings, and you can see we had one in COVID, we had one at the bottom in 2018, in 2016, 3 readings here at the bottom of the correction in 2011. So it's definitely not a perfect indicator, far from it, but it does show us that the strength that we're seeing does often correspond to bottoms. In fact, even in 2001, here in March 2001, we had that type of 3-day thrust, and it led to a nice 20% run. Again, this chart makes it look nice, right? That these often correspond to lows, but look at 2008, for example. We had several readings and the market just continued to come down. Now, a bottom was forming throughout this period, but it didn't trigger a nice rally for months. And same thing in 2003. And another big point to highlight is that we had the same thing in March 2022. So again, this is the type of thing that we like to look at. We like to include it into our analysis and into our convictions. But this is a perfect example where you can get whipsawed. You can have positive signals. You can have strength on a move that suggests that we should have more upside or that this was a significant bottom, and yet the market continues moving down because there are exceptions to every rule, and nothing guarantees that that can't happen again. And that's part of the reason why we stayed so optimistic on the market throughout this period, because we had these types of rare market signals here in March, that we had these types of rare strength signals in March that, effectively didn't play out, right? So is anything actually different today to what we saw in March? Because we're just looking here at something that we saw the exact same thing in March. So is anything actually different? And so I'll give you guys one more sneak peek at this article that I wrote. And this is the McClellan oscillator. Now, this is a very, very important indicator. We've used it many times in the past, and it essentially gives the momentum behind the underlying breadth of the market. So what's breadth? It's the participation of stocks. So it gives you the strength of the participation of the stocks in the market. And so you can see here, why we're looking at this right now is that we've had a very, very impulsive reading. And this is a lot stronger than what we saw in March, and a lot more similar to what we saw at the beginning of the rally in 2020 and at the beginning of the rally in 2019. In fact, we took a look at the historical context of this, and going back to 1962, it only occurred 12 times, and 10 out of those 12 times it led to gains on the S&P 500 looking out 12 months with an average return of 20%. Right, so these are crazy, crazy numbers. 20% in 12 months, a win rate of 10 out of 12. That is statistically significant. That is very impressive. So when you have this type of thrust in breadth with a move up, that's generally good news. Now, does that mean that we just have to forget about those two exceptions that were in 1974 and 1977? No, right? And that goes back to the concept that nothing is 100% in the market. You're gonna have to bet somewhere at some point, and that's also part of the fun of being in the market. By the way, if you're so far enjoying this video, make sure to smash that like button as hard as you can. We're really trying to push these videos out to as many people as possible. With your help, we've been able to grow this channel and really get this education and research out to more people, so it is really appreciated. But this analysis, these types of signals, these types of updates, we make them frequently to give you guys big updates on what's going on with the market and back it up with historical data. Now, we try to be as detailed and thorough as possible in our analysis, but for the ones who just want to take a couple of minutes to read the article, take a look at the charts that we've made, we highlight the important parts in bold so that you can just skim through the article and understand what's going on. And then of course at the bottom we make a summary of where we think the opportunities are right now. So if you want to have access to this type of research where we give you guys signals, we send you that notification update, as soon as we see these developments play out, make sure to go and check out gameoftrades.net if you want to have access to this kind of service at a very affordable price. So while a lot of this is incredibly exciting, I know many people in the comment section are very skeptical regarding the bullish case. And again, as I said at the beginning of the video, there's plenty of things to worry about in the market. So, I understand that 100%. But again, at the end of the day, you have to make a bet somewhere. But when I see this type of strength in the market, this type of recovery, it does give me some confidence despite the market being overbought in the short term. I don't think that's particularly statistically significant, but I do have to keep myself from getting too excited, because if we take a look at three of the key moving averages that exist on the SP 500, that's the 100, the 150, the 200-day moving average, we're still well below that. Yes, we covered a lot of ground very quickly, but that's because we were very oversold. We were due for a bounce. That was really the case that we made throughout the last few weeks. In fact, the last 3 weeks, we've been calling for a nice bounce, and we did retrace a big part of that very, very rapidly, but the S&P 500 still has a lot of work to do before getting back in an uptrend, right? So that depends on your trading style. Now, obviously, bottoms are made when things look very bad, when these moving averages are curling down, when they're above the price, right? Again, in 2018, you have a bottom made when these moving averages are coming down and the market still has a lot of work to do before being in an uptrend, right? Which occurred in February 2019 in this case, and in June 2020 here. That's when we were really above the moving averages and the trend really started to look like something more durable. So that depends on your trading style, how aggressive you want to be. We do have some very solid strength signals here. But from a trend standpoint, we have moving averages curling over and prices below these key resistance levels. If this signal here ends up giving us, if this signal here that we have on the breadth thrust that we had here, if that ends up not being an exception like it was in 74 and 1977, if it ends up giving us a 20% return or 22% median return, well, that would suggest that the market will be back to its all-time high in the next 6 to 12 months here, and well above the moving averages. That's if it's not an exception. And you can see in most cases it was actually above 20% return in the next 12 months. Now let me know in the comments section what you think of this signal, whether you think it's relevant. We really appreciate all the comments that we get, as long as they're polite, they're civilized and constructive. It gives us a lot of extra insight. It's just absolutely fantastic being able to communicate with the community on these things. So it is really appreciated. I hope you guys enjoyed this video. If you did, make sure to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.